it would typically actually be today that we would have the maximum pressure, which would be a day before final settlement, which, as you will recall, was actually what happened last month. You know, as you mentioned, we did put out a warning saying, unless you guys do something about this, it's going to get a whole lot worse. And we thought really that the industry walked off a cliff. I mean, we could see it coming. It was fairly straightforward. As you know, calculating oil markets is pretty much addition and subtraction. And we were surprised by how bad things got, but not surprised that we did go negative. Now we've avoided that, and things are definitely improving, as Brian was highlighting. Right. So let's get to your playbook now. You know, your kind of crisis playbook, so to speak, for energy, as many investors have shied away from this sector. What would your advice be? Where would you put your money to work? It's interesting. I think people are very keen to buy the market, and anywhere where you can get a genuine secular story to add to the fact that people want to buy the market, we see a lot of positivity. So, for example, the refiners, if you're talking about record gasoline demand this summer, which is what we've been highlighting for a couple of, for 6 weeks or so, then obviously the refiners should do very well, especially if crude markets remain under pressure, and we think they will. The other one is natural gas. Obviously, if you're massively cutting U.S. oil and gas production, particularly the associated gas that you had with oil production, which was sort of a byproduct, is going to be greatly reduced. And so people, even though in the case of both refining and natural gas, it's not a natural seasonal time to buy those stocks, given the market, there's a lot of positivity towards those two trades for sure, and we've been on those. What would some individual names be, and what would you say to people who would think about buying energy as kind of the ETF? I think the hardest thing for us has unquestionably been that the market's buying highly indebted companies, and I think that's a cost of capital trade. We stick with quality. You know, the refiners now, the Phillips Petroleums, the Valeros, really have outstanding managements. And, you know, we're very happy long those stocks. We also think they'll make a lot of money, particularly as we see crude prices under pressure and gasoline markets boom. And then you have the good management and the good business models. So we're positive those two names. Amongst the E&Ps, we're just pure play Permian, best in class assets, you know, the Pioneers of the world and the Diamondbacks of the world, the PEs and the EOGs. All these guys have very good managements with very good assets. And finally, anywhere else in the energy space you would look? You know, we spoke a little while ago when I asked my guest last hour if he would do anything in energy. He said, you know, maybe we'd start to look at Chevron here at some point. What about kind of the Exxon, the Chevrons, you know, the biggest of the big? Well, Chevron's outperformed Exxon for like 10 years now, no kidding. And, you know, eventually that trade will end, especially if you're bullish refining. I think I've been concerned about Exxon and very concerned about their levels of CapEx. But they've essentially been forced to address that. And if you love refining, you could begin to think about Exxon as a play here. But chemicals do remain under considerable pressure, and that's a problem for Exxon in combination with its very high exposure to Asia GDP. We're still pro Chevron. Interesting. So still pro Chevron, but maybe thinking about whether that's coming to an end. Yeah. Right. I think at the especially with Exxon with a four handle, you know, it's not the trade that it was obviously before the 10 years of underperformance started.